No, I'm just ready to learn more about taxes for business owners.
Really?
Yeah, it's not one of those things that necessarily can say that I love to do, unless, of course, you're a tax accountant, right? But for all of us, it's just a necessary thing. And so, again, the premise of the business owner mindset is to make sure we're thinking correctly, that we're thinking as an entrepreneur, and we're doing all the things that we need to do to be successful in business.
Yeah, I agree. I think that one of the things that I want to take away from today is that the word taxes has to mean such a negative connotation. A lot of times people, when they think of the word taxes, they're thinking of like somebody coming and taking money out of your pocket. But the truth of the matter is, in this statement, is you've made a profit. So to be in a position to be taxed is a good thing, because if you have zero money in your account and you don't do zero business, there's zero taxes. So I think the idea that you put yourself in a position to be taxed is a good thing. Now the question is, how do I pay my taxes? When do I pay my taxes? And then how much should I pay in taxes? Those are all things that we're going to try to answer today for your business. But in general, the idea is that you made a profit. So let's be happy about that. So how do we make a
Right,
profit? Let's start with the beginning. How do we make a profit, right? Well, I'm Atlanta business attorney. I think that question right.
exactly.
I don't know. Maybe our slides is an update. But our schedule today will be, talk about the topic first. So usually I talk about myself, and this time we're going to do it a little bit different. We're going to get into the mindset and then go right into the topic, and then we'll talk about me and have a conversation at the end. Um,
Yeah, so Dave, you're going to go over the business owner mindset and just what those things are. And then after that, we'll do the topic.
Sure. So let's get into the business owner mentality, because we have to establish a business. We have to get into the mindset of the business. And this is what we do at the business owner mindset, is try to reset people each week, get them to a spot where they feel good about themselves and their business and what they're doing, and kind of move forward in their journey of entrepreneurship. And part of that is understanding that we're in a unique group of people who think differently or wired differently, and we make our money solely from our business. And in order to do that, you have to have a certain set of principles. You have to have a certain mental mind state that makes up your business. And what we try to do here is try to give you resources and information so that you can feel more confident about starting your business or staying in business. And along this process, we try to have other business owners join the conversation, ask whatever questions that may have. This is a safe space for business owners to come ask me as a business attorney some questions about business. There's no such thing as a silly question or I should know this. Good business owners, really good business owners, understand that they don't know, and they're not afraid to ask questions, and they are able to outsource the things that they don't understand. So, trying to really tap into your DNA as an entrepreneur and going out and becoming risk, taking some money you have, right? You have money, and now you want to go out and create some sort of risk with that money. And to do that, you're going to um, use the information around you to capitalize on the amount of investment that you have. So from that perspective, we're trying to change your thinking process, trying to engage you into some problem solving, and then helping you with some ideas that I've seen the work over time in my 22 years as a business attorney. It's not easy. Everybody's path to business ownership is not the same. But wherever you are in your journey, you're right where you're supposed to be. So that's the first thing, is people put too much pressure on themselves to be at a certain point in their business than they need to be. And the truth is, it's not easy to get a business, and it's certainly not easy to predict or make things happen ahead of time. You have to use your time in your day efficiently. As business owners, we use 12 to 16 hours of our day to try to capture revenue. We're constantly thinking about our business, constantly thinking of ways to make more money, either through, getting more customers or spending more time with the customers that we have, and talking to other business owners, and really understanding that this is the same 24-hour everyone else has. It's just as business owners, we use our time a little bit more efficiently, but we should. And the best way we do that is by outsourcing the things that we don't understand and focusing in on what it's going to take to bring in more money into the account. Because a business that doesn't generate revenue is not a business. You have to generate, somebody has to give you money for a service or product. And once they do that one time, you make a cookie, somebody buys it one time, that's a business. Now what we have to do is replicate that process and spread it out across not just your friends at work, but the entire world, right? And what we're going to do next week, actually, with our speakers, a little bit on that is on how do you get that customer, flip it over, and keep your customer. So I'm looking forward to next week's talk as well. So again, this is all about money. There's no secret to it. We're not a nonprofit, we're for profit, and it's okay. Because at the end of the day, you're bringing in as much money as you can in your 12 to 16 hour business to try to be able to offset your expenses. And the way out of business is to make more money, not to cut expenses. So when you start looking at problems, you can't just say, oh, I'll just budget my expenses and then I'll have a little bit of extra profit. No, you got to go out and make more money. And the more money you make, the more likely it is that you're going to have profits, and those profits will get taxed, but we'll talk about that later. We also talk about outsourcing, never getting too, proud to ask for help, never understanding that you can't learn everything in business. You can't learn QuickBooks and articles and bank accounts and all those things and still go out and operate your business. I mean, you can, but now you're going to lose a lot of energy and time on the things that are really more necessary. So really, it's part of your risk being able to find people and other businesses that do the things that you don't understand is a key component. And then, lastly, expanding your relationships, getting to know other people, networking, coming to events like this, discussing some ideas, being around other business owners. That's an important part too. A lot of times, getting advice from people who are not in business is not always helpful. I find that business owners tend to help you out because they understand the struggle. They understand, how you got off your feet. They can give you advice about websites or trademarks or whatever the case might be. So there's generally what I try to do here is try to tell you there's 3 different phases of where your mind is in the business at one given time. This is not an exact science, but you have to try to encapsulate it somehow. And, 60% of your mind in the early going mostly is focused in on your structure, right? The things that are common among every single business, regardless of what service or product you sell. So in this case, you're thinking about things like your LLC and your EIN, your insurances, things like this. This applies to every single business, no matter what service or product you sell. And then your mind also bounces in now cash flow, bringing in more revenue to create more cash. And that does depend on your business, right? Depending on if you're offering products or services, do you have inventory, et cetera. Maybe you have a brand, maybe you have a real estate company that doesn't have a brand and you're focusing in on, finding other real estate and finding investors. So this middle hexagons, they change depending on your business, but there are things you're still thinking about nonetheless. And then on the far right is your growth section of your business where you're thinking beyond your business, right? You're thinking beyond the structures and the day-to-day of making money. Now you're thinking about where am I going with this? What am I trying to do for networking, donations, volunteering, being a difference to somebody else? This is something that most business owners think of as well, is that, your business is up and running and it's humming. But no matter if you are a successful business that spends a lot of time on the growth side or a new startup that might spend more time on the structure, your mind is constantly floating between these concepts. And I wanted to put this up here to let you know that you're not alone, that other people have the same exact problem. They're trying to figure out from the structure side, all these issues that are bouncing around. What we try to do here at the Business Owner Mindset is to try to get some of these issues a little bit under control by giving you ideas on how to do things in your structure. We occasionally touch on, things that's related to cash flow and mentoring, but the idea is that if we can get these basics down, it's going to help a lot of people on this call. And by the way, I have clients or potential clients, I should say, that call me that says, hey, I saw the bond mindset on this topic and I thought I'd give you a call, or I have another follow-up question. So even if there's not an immediate response to something I say, it's okay that it comes up later again. And it's okay that we keep doing this every week to remind people and reset, because each time someone can hear something different. So, in the terms of the cash flow phase, we like to bring in people on these topics to talk about them. We had Spencer Charles come on to talk about how he generates cash flow for his sports agency. So if you have a business you want to talk about, and you want to talk about how you generate cash flow and some of the issues that's in your business on how you deal with it, we'd like to have you. So just get in contact with us either through the email or the Facebook Live, and we'll try to schedule a time for you to come on and talk about your business. I mean, because this is not just about me. This is really an open dialogue for everybody else. And then on the high end, you're also talking about going out and creating new opportunities. If you are an advanced business owner, you might be thinking of other ways to sort of help the community and or expand your overall enterprise or enter into a new venture. So some of those topics might come up as well. So we have a few minutes here. Then we're going to start to talk about taxes. While we have a few minutes, do we have anybody that we want to say hi to this morning? Let's see. Dean is online. Dean, good to see you. Good to see you. How you been?
I'm doing great. How are you?
Good. We fixed our technical problems. We're back this week, Dean.
Good.
I know
I see.
I know you didn't get much sleep thinking about, those taxes.
No. In fact, I could hardly wait to get up this morning.
You're a funny guy. Like I said, taxes are actually a good problem. If you look at the genesis of where they come from, it's actually a good problem for you. So we can get into it now. I think when you look at our structure, taxes is obviously a big part. Sometimes people don't get into business because they're scared of the taxes. And I say, no, don't do that. Don't worry about taxes, because one, it's not an immediate threat. Two, it's a threat that can be handled before it becomes a problem, right? And then lastly, it means you made some money. So let's kind of simmer things down here and go from there. So we're going to talk about taxes, and I think this is the point in which Shar starts to do some note taking. I don't necessarily follow the note taking all the time, Shar. So if you have questions, or if I'm saying something too fast, you can just say, "Hey, Dave, can you repeat that?" And then I think it goes from there. So,
are you saying my screen?
Yes, I see your screen.
Okay. Cool beans.
Yep. So taxes, I think it's important that I talked about everything from a kindergarten level. So, and then we can get more complicated. So I'm going to explain this like I'm talking to my 10-year-old daughter, who actually has no idea about taxes. Like what is it, and what does it exist? So in America, well, other countries as well, we have a system in which the government oversees certain things that is for the benefit of the whole public, and not necessarily for the benefit of one individual. Your roads, your bridges, things like that I don't go out and personally fix the potholes. I don't go out personally and build the bridges. So you have things that we all commonly use that it doesn't really make sense. Think of it as a large HOA. Taxes is just a large HOA where someone pays for, taking care of your landscaping on your ramps, taking care of your infrastructure, your office buildings, etc. So we got to do it. Now, how do you get your money from your taxes? How do the government collect money from taxes? How do they get the money from you? Well, the true answer is they actually let you tell them how much money you made, and then you pay taxes on that. So the natural system is that the government says, hey, at the end of the year, we like you to tell us how much money you made, whether you are an employee or as a business owner. We want you to tell us, and then tell us on the honor system how much you should pay in taxes, right? So they're actually giving you the benefit of the doubt that, you're going to tell us the correct things, and then you're going to pay the correct amount based upon what you told us. So for an employee, they consider all of the money that you receive from your employer as profit, meaning that the government doesn't tax you on money that you have saved up in your account. They tax on money that gets added to your account. So if you're an employee, all the money you make from your payroll is considered profit that's taxable to them, right? So they say, okay, 10% Mr. Employee, you made $50,000 this year. You must pay taxes on all of that because that's all profit to you. Well, it works differently as a business owner. And a business owner, if you go out and someone writes you a check for $100,000, or even let's keep it the same, $50,000, the government doesn't tax you on that $50,000. The government says, okay, your revenue is $50,000, but now how much is your profit, business owner? Because unlike an employee, you probably had expenses to generate that money. You probably had to pay for office space. You probably had to pay for pencils and paper and copiers, et cetera. So we're going to treat that as an expense against your revenue. So if you brought in $50,000, but you had $25,000 in expenses, then the government says, okay, great. Your profit, unlike the employee, is now $25,000. So
Dave, do me a favor, look at what I wrote and simplify that for me.
Well, so I think that the best thing is to probably just do large bullet points for now, because this is just background stuff. So if we get, I don't want to get caught up in the woods in this because it's going to get way more technical. I think that covers it for now. It's just bullet points of kind of how taxes works. And then we can get into the more sophisticated stuff. I think that's fine though. Okay, so that's something you can search the internet for on how taxes work. I wanted to start there. Was there anything in the substance of what I said that you didn't understand yet?
It's just that your talking is a little bit faster than my typing, so I just wanted to make sure I captured it. So keep going.
Yeah, I think that in all fairness for the typing, you just need to bullet point the topic points, because you're probably not going to be able to, keep up exactly word for word what I'm saying. So, and this is taxes, so it's going to get heavy. So the first difference we see in taxes is that the government assumes the employee, all their money is profit, and it gives the business owner the benefit of the doubt that the money you receive is not all profit and that you have expenses. So how does the government know? So you say, well, if I'm an employee, how does the government know how much money I make? Well, at the end of the year, the person who gave you the money tells the government. They say, hey, this person works for me, Shar and Dave. I gave Dave $50,000. That was his profit for the year, and he needs to pay his taxes on it. And they let the government know. And that's in the form of your W-2. So at the end of the year, when you get your W-2, you're getting it and the government's getting it. Whether you tell people or not on your taxes, the government knows how much money you made as an employee. That's called your W-2. If you're a business owner, you go, well, if somebody wrote me a check for $50,000, how does the government know I received $50,000? That's what you call a 1099. At the end of the year, another business might give you a 1099 that tells you, hey, I gave you $50,000. You handle your own taxes, or they'll send a copy to the government. So if you received a 1099 from someone, the government knows how much revenue you received. They're not going to treat all of it as profit. They're going to give you ability to mark off those expenses. So automatically a business owner has more room to make an argument on their profit than an employee does. An employee, they're going to say that's all profit, and they're going to treat it as all profit and pay taxes. So as an employee, this is an important point too. As an employee, not only do you have to pay taxes on the $50,000 you made per year, as they give you that money each week or month, or as you get paid, they take out what's called the payroll tax. Okay. The payroll tax means you put money towards the federal government's tax system of Social Security, Medicare, Medicaid, right? And it's called FICA and FUTA. I'm not going to get into what those means, but just know that every time you get a check, so if you got $50,000 and you got $1,000 a week for 50 weeks, your check, if your employee, doesn't say $1,000, it says like $800 or something dollars, right? Because they take out money for that payroll tax. What's interesting is both the company, the business owner, and the employee pay a payroll tax. So when you get $1,000 per week and then you only get your check for $850, the business owner actually pays $1,115. So the business owner says, hey, I said I'd pay that person $1,000. Why am I paying $1,000 plus the money, $115? And the answer is the business owner actually has a tax that it shares. So half the payroll taxes for the employee, half of it is for the owner. So now the employee goes, wait a minute, government. I said I pay my tax on the 50,000, but you took some tax money out before I got my 50,000 when I got my payroll. And they'll go, that's true. That's true. But they treat that money as being kind of in your account, into your Social Security account, into other places. And so when you get your taxes, they factor that in when you do your taxes, that you had that payroll tax taken out. Same thing with business owner. If I'm making 100,000 and I had to pay someone $50,000, and I had to pay a payroll tax on top of the $50,000, that payroll tax is deducted from the amount of money I made. So if I have to pay Dave $50,000 plus another $5,000 in payroll taxes, I get to deduct $55,000, the cost of Dave's salary plus his payroll tax, out of my account. So the employee is really left with a very straightforward tax system. You pay your payroll tax, you pay your taxes on the amount you made, you get a W-2, and at the end of the year, you pay your taxes, and they see, oh, sorry. The government also for employees does something else. And you can bullet point this, Shar. The government for employees, not only do they take your payroll tax out right away, they also take a little bit of money on the taxes that you're going to owe for that $50,000. So not only did they take their 7.5% off for your payroll tax, they say, oh, you know what, Dave, you get $1,000 a week. First, I'm going to take 7.5%, or roughly $70 off of your taxes for your payroll. And then I'm going to put some money aside. And I'm like, money aside for what? Oh, for your taxes, because we don't really necessarily know if you're responsible enough to have the money due on this $50,000 at the end of the year. So each week I'm going to take maybe another $200 off of your taxes and put it into an account for you. And you're like, what? I'm like, yeah, I'm going to take $270 out of your $1,000. $70 will be for your payroll taxes. And I'm going to take $200 and put it aside for your taxes later. Well, who determines how much money the government takes out of your check as an employee is actually determined by you, the employer. You actually, when you get your job and you fill out those forms and they ask you for exemptions, the government calculates roughly what your tax might be and will start pulling money off your account so that you have enough in your account that when you do your taxes at the end of the year and you say, okay, you owe taxes on $50,000, that tax comes to, let's say, $5,000 or even $10,000. They go, oh, we've been collecting $200 per paycheck, so we have money towards that tax for you already. And so the government essentially holds your money, your tax money that gets withholdings. Your tax withholdings is literally that. They're withholding the money that you are normally entitled to pay your taxes. So can you take that out? What?
I have a question for you. Is there a name of that form that you fill out, that the employee fills out to have the amount of taxes withheld?
I believe it's a W-4 form, right? I believe when you first start working, they give you a tax form called a W-4. You know, you just sign in all kind of stuff when you first take a job. But one of those will be your W-4, and you put your exemptions in there. And then they'll actually have a box to say, do you want us to take more money out for you? Because maybe you have, you know, other things that you're worried about, or you want to make sure the government has enough money to cover your taxes. So you can actually tell them exactly how much money you want them to withhold from you. And so ultimately, as an employee, you pay your payroll tax, and the government takes your money. Now, I'm not a big fan of that as a business owner, meaning that if you work in January and the government takes out, you know, $300 or $400 for a tax that I don't pay until April of 2021 or April of 2022, they're holding my money literally for 14 months. Now, if you don't have anything to do with the money and you're not really actively using it on something, I guess most people can deal with that. But for me, and if you're disciplined, the idea is that sometimes if you're listening as an employee, you might reduce your withholding amount and say, look, I'm responsible. I know I might owe later, and so therefore I want to make more money available. That's actually a trick the politician does, and I believe that happened recently. If people haven't noticed it, is, you know, the president will say, hey, I'm going to give you some more money in your paycheck. All he's doing is reducing the amount that the government requires to be taken out of your paycheck, so that when your taxes come around, you might actually have owed So you got a bigger paycheck, like, oh, my paycheck used to only be $730. Now it's $850. Oh, I'm making more money. Not true. The government just took out, $80 less what they were holding. So when your tax comes around at the end of the year and it's still $10,000, instead of having, $7,000 or $8,000 saved up, now you only had $3,000 or $4,000 saved up because the government took less out to withhold for you, and now you owe a big tax sum. So in the last few years, I've seen people who used to get tax refunds actually owing money. I was like, well, they just didn't take enough money out. So I think it's important to understand how taxes work from the employee side, because it's markedly different on the business owner side. But that's what most people know about taxes, is kind of like, hey, I pay some taxes with my payroll, and then I pay some more taxes for my tax return. But the truth is that they're really just escrowing or putting that money aside. The government's holding it until you do your taxes at the end of the year. So as a business owner, it's a lot different. If I go out and I get a client and the client pays me, $1,000 a week for 50 weeks, I have what's called $50,000 of revenue. But unlike an employee, I could actually expense out the things that I've been doing to earn that revenue. So if I had to buy business cards and I use my business bank account where that $1,000 a week has been coming into to swipe to buy some business cards, the government says, okay, that's legitimate. If I use that card and I go out and write a check to my landlord for my office space that the client comes to give me $1,000 a week, the government says that's okay. All the effort that we've been doing as business owners to make that money come through the door, you get to deduct as a business owner. So from that perspective, it's important that, as a business owner, you start to understand that you have more leeway in terms of reducing the amount of money. Now, as an employee, you don't have those expenses, right? You don't have to pay for your business cards. You don't have to do any of that because your boss took care of it, right? So that's why the government says all this is profit to you. But you, Dave, you going out, putting your website up, we're going to let you deduct your expenses. Now, what expenses can I deduct against the revenue that I made for the IRS to approve it? And that literally is why you get an accountant. If you're using your business card and you're using it properly, your accountant will tell you what's proper to use your accounts for it. And they'll pull down your bank account statement and they'll say, Dave, you have Office Depot here. What happened? Oh, I bought a copier. Okay, Dave, you have rent here. Who's that? That's for the landlord, right? Dave, you have some expenses for this employee. Yes. And you have payroll taxes. Yes, that's okay. Dave, I see here you went to Six Flags and bought some nachos. Yeah, no, we can't do that. What? Yeah, you did. That's not for your business. It was not associated with you getting law clients. And so therefore we cannot use these nachos as an expense. So we cannot deduct it off of your $1,000 income. But that's practice. One of the things that can get you in trouble from a liability purposes is if you're using that business card to do things on your personal level like that. So you keep using your card for nachos or going to the store to buy milk, things that you personally use it for, or going to the movie theaters, just using the card flimsy. Not only is that stuff not tax deductible and the government treats that money as profit, but also too, you might be exposing yourself to a liability because you're not treating the business officially. So a lot of people though push the edges when it comes to expenses. They'll put in something that they sort of want to use long-term personally, but not necessarily for the business. And the biggest thing is the car, right? People get the car and they expense it out. Oh, $1,000 a week. Well, this is not all profit. I had to spend $200 on my car because, the car is the business's car. I use this car only for business. Well, the IRS determines that, right? And so if you see somebody going around with their car wrapped up in, their brand, sometimes they have to do that because they're about to get audited and they want to make sure you're using that. But if you have a personal vehicle that you're just driving around in and going to visit family members or, going to the store and you just put it in your business and your business doesn't really use a car, then ultimately that's not an expense that will be recognized by the IRS. So it's important to have an accountant to see what the right expenses are. But once you have your profit and then you have your expenses, it's okay. I made 50,000 this year, but I had, $25,000 in expenses by the time I took all of my expense out. So I made $25,000. So what do I do now, Dave? So at the end of the year, usually the end of the calendar year, December 31st, that's the cutoff point when you're a business owner of what your profits would have been for the prior year. So between December 31st and April 15th, or March 15th in some cases, you have to decide how much profit you made in the prior year by going through, collecting all the revenue you received, deducting all your expenses, and then you come up with a profit amount. That profit amount is really where the sophistication of knowing tax structure is really can be determined. Because let's be clear here. I made $25,000 of profit. We should all be happy for that. There's no doubt about that. 25,000 is better than zero, because if you bring in 50 and you spend 50, there's no tax problem because you had a zero profit, right? So the idea that I have to pay a tax is a good thing because you profited. Now, the question is, as everybody's instinct, you don't want to have to pay more than you should, right? You want to say, hey, if I made $25,000 in profit, I know I got to pay taxes. Don't get me wrong. I want to pay my taxes. I want to be part of the community, but I also don't want to pay the most because I didn't know what to do, because the government gives you so many menu items on how to be taxed on that $25,000. A lot of menu items. They have their most popular, and the default, I shouldn't say they're most popular, but the default menu item is that they say, listen, Dave, that $25,000, it's all profit to you. I'm going to give you a self-employment tax. And you're like, well, what is a self-employment tax? Well, you know how you kind of got around the employee 7.5% being paid by the employer and employee on the payroll tax? Like, yeah, well, we're going to take that $25,000 and we're going to tax you 15%, basically both sides of the coin, because you're a business owner. And that's what's called a self-employment tax on that $25,000. So people are like, whoa, like I did not know that. I did not know that I have to pay a self-employment tax on my profits, similar to what an employee and employer does. And the government's like, yeah, we're going to have to tax you on that. And then you go, okay, well, what is that? It's okay, it's 15%. All right, I'll pay that. But then the government says, okay, what you had left over? Yeah, after the self-employment tax is taken out. Yeah, let's say you got, $20,000 left after self-employment tax. Okay, now we're going to tax you regularly on that. Like what? And like, just like in a W-2, you got to move that 50,000 over and get taxed on it. Whatever you have left after that self-employment tax, we're going to tax you on that under your personal. So now I got this $20,000 that I made, and I got to put it in my 1040, and they tax me on it just like they would the person who had 50,000. And there's a line item for a W-2 or an employee income, and there's a line item for your business income. And you put that number 20,000 on your personal taxes and you get taxed on it. So that's generally what they do, and they let you tell them what that number should be. So that's what your accountant's for, is it helps you calculate how much money you profited, how much is your self-employment tax, and then how much is your personal taxes after you move that over. And so it's important to have a person that has a strong financial background, tax background and accounting to do your taxes. You don't really, if you're a business owner, you don't want to have someone treat your taxes as if you're an employee, because it's a different tax system. It's a different idea on what's expendable or not. So I always recommend, and this is why business owners will hear this, is that you have an accountant, because they can look at your bank statements, tell you what expenses that's appropriate that you're spending on your business and ones that are inappropriate. They can calculate your profit. They can calculate your self-employment tax on the profit, and then they can calculate your personal, and they'll give you a number. And then on April 15th, you'll pay that number, whatever they give you. And so therefore you've gotten the value of all of your checks, that $1,000 a week that client sent you throughout the whole year. You have the value of that. Now, what happens in business owners' real lives? In real life, you might have made $50,000 as of December 31st, but it's now April 15th, and that money or those profits are somehow gone or inside of your business. So what do you have to do? Well, the government doesn't care. So if they say as of December 31st, you made 50,000, you made $25,000, to go back to our example, you made $25,000, we need to see that 5,000 in self-employment tax, and then we need you to pay your personal taxes on that other 20,000. So let's say that's another 5,000. So we're gonna need $10,000 from you. And you're like, well, I know I had it in December, but I don't really have it now because COVID or other things happened. And, you know, since that time, I don't really have that government, and the government doesn't care. And that's the downside of being a business owner, is that unlike an employee where they take it out as you get your money, as a business owner, you have to be disciplined enough to put it aside and not spend it. So sometimes business owners get in trouble because they made their money, but then they have a down, you know, your next year's not going so well, and you don't actually have the profits anymore to pay the tax when it's due. So how do you do that, Dave? I'm not good at accounting. I'm scared that I'm spending too much money, that I'm going to have a problem with my taxes because I made money, but my business goes up and down, or it's seasonal, and I'm just not sure if I'm putting enough money aside for taxes. How do you fix that? The government actually has a program in which they quarterly require you to take some of your anticipated profit and put it into, send it to them. So you can actually, as you're making your $1,000 a week and you roughly estimate how much profit you make each quarter, you could actually make prepayments to them, very similar to the employee withholding, voluntarily, of course. So you could say, hey, you know, government, it's first quarter 2020. This is the profit I made. I just going to go ahead and give you some of this tax money now. So you can work with your accountant to do that, and they'll tell you what your quarterly tax contribution ought to be, so that you don't have to worry about that at the end of the year not having enough money. So that's one way to kind of sort of become more disciplined, is to have an accountant set you up on a quarterly plan with the IRS, so that you know you don't have to worry about lump sum, and then you can adjust. If you have a good quarter, you pay some. You have a lesser quarter, you can kind of figure out what your tax is going to be and pay a little less, and you can kind of judge it as you go. So again, that's for the people who are just like, look, I don't have the discipline. So another way, however, to pay less money on your $25,000 of profit is what's called a S corporation taxation. Now, I'm glad this session is almost over, because there are going to be some accountants and other people on here that's going to say, hey, wait, I have information on this. But essentially, the IRS, as we mentioned in the EIN episode, the IRS gives you a category of options to choose on how to treat that $25,000 of profit. An S corporation is essentially where you decide to say, listen, government, $25,000 of self-employment tax is a little bit high, because if I worked for me, I wouldn't pay myself a $25,000 salary. I would have paid myself a $15,000 salary. So S corporation taxation, which is just a tax category, not the company you formed at the Georgia Secretary of State. It's just a tax category. It's called S corp. It doesn't mean you're a corporation. It's just called that. I don't know why the IRS did that. It made it harder for regular people to understand taxes, but they didn't need to call it that. You could have just called it, you know, special tax category. But the fact they call it S corp confuses people, because they think they need a corporation. Anyway, the S corp says, okay, great, Dave, you got $25,000. Then what we're going to do is not give you, we're going to let you pay yourself as an employee. Like, what? Yes. Just like the employer-employee relationship, if you're going to be taxed, you only want to be taxed on the amount of money you would have made as an employee. So if I'm saying that the person who does my position would not have made $25,000, I would have hired somebody at $15,000. Then the government says, okay, you can hire yourself and pay payroll taxes and do that for yourself. So your business literally hires you. If you have an S corp, your business hired you. If you have an S corp and you don't have a W-2 from your business, you're not doing it correctly. You're not doing it correctly. If your tax is an S corp and you're not paying yourself a payroll, you're not doing it correctly. And you should talk to an accountant. The S corp is set up so you can pay yourself a payroll and save on your self-employment tax. That's all I'm going to say about that. Remember, if you don't have an S corp, the $25,000 is subject to that self-employment tax. Well, if you do have an S corp and you pay yourself a salary, you get that payroll taken out, then you don't have to pay self-employment tax on the rest of the money that's left. So if you have to pay yourself a salary of 15,000, you pay your taxes, right? The employee 15% taxes, you pay that. But the other $10,000 comes without the self-employment tax. That's very complicated stuff. It's high level sort of, we've reached the forest of this dense tax issue. I'm not going to go into, well, what if I have an S corp in half the year and then I flip into, or I have a regular taxation and I flip to an S corp half the year. It gets really complicated. Talk to your tax advisors. They're everywhere. But this just gives you a general feel like how this is all good, right? It's all, at the end of the day, everything scenario I talked about is either you made a profit of $25,000. So, Shar, do you have anything you want to add into this?
Yeah, I stopped typing at one point because I was too busy listening.
That's the point of it. That's the point of it. It's good.
I'm like,
What
okay.
resonated with you?
I think the S corp at the very end really resonated with me because, I think for a lot of people, we're solopreneurs. We're not necessarily a small business owner, meaning that we have employees. We more so work for ourselves. And so I just found that very interesting. I always thought that S corp was a type of business, not a tax category. So
No,
I
it's
know
just it's just the tax category. And what it does is it allows you to, remember I said how if you had a regular business, when I call it the regular taxation, that's actually called a pass-through or disregarded entity. I just been calling it the regular business owner tax on that 25,000. But in that scenario, remember I said you could quarterly pay the government in case you don't want to have a lump sum due in the quarterly installments. The S corp in being a payroll tax actually is a form of that same imposed discipline as well, because now you're paying yourself a salary in which the self-employment tax is coming off of, and you don't have to worry about, oh my God, did I save enough money because I did it in my taxes to myself when I did myself a payroll tax. So that's another way too. But it also does two things to pay yourself a salary. It gives you a W-2 form, because when you go out and you try to apply for credit and you try to do other things, trying to show them 1099s and my whole tax returns, the business owners, we have the worst time trying to do things with credit because of how we structure our businesses.
Absolutely,
and
absolutely.
They're looking at, okay, well, this is your tax return and you have these expenses. I need to see the backup. I need to see the bank statements, and they kind of do a whole examination. Whereas if you get a W-2, they go, oh, this is how much money you made, period. At the end, they put it into their calculations and they go for it. So a lot of business owners do a W-2, not necessarily for the whole, prepaying all of my payroll tax, but because I want to have a salary that I can give to somebody when I apply for credit or get a loan, that they can say, okay, this is how much money you make. And I don't want to have to explain to them, I know I made 50 in revenue, but here's what I had to spend on my car, and this is what I had to spend on this. And that's really what you have to do if you're a business owner to go get credit. You can't just say, hey, look at my 1099s. They do not care. Like, I need to see your tax return. And how many business owners do their tax returns on time, right away, et cetera? There's extensions that go into play. There's a lot of people who play games with extensions. So the April comes along, you don't have your money, you tell your accountant, extend it until October. People don't know this, but you can extend that. So you can push it out. Now, you should know this though. There's all these little details, but if you are an S corp, your tax return is actually due March 15th, not April 15th.
Oh, okay.
Yes. So if you have an S corp, your tax return for your company. Also too, when you become an S corp, you have to file a separate tax return for your company. See, when you're under the regular taxation, you could all just kind of file it under your one tax return. But when you're an S corp, your company has to file a tax return separate from you. So they file that in March. So that's why it's very important. If you have an S corp, I don't form S corps for people unless they have an accountant, because there's so many things that can go wrong with this tax category. It's unbelievable. And sometimes people just do it because they read it somewhere, like, oh, I read about S corp, so I formed a corporation. Wrong. Should not have done that. Form an LLC, because the LLC can still use the S corp taxation. And then two, they'll say, I say, what are you paying yourself? Oh, I'm not paying myself salary. Like, well, are you filing the tax returns? Oh, no, I didn't. I mean, I just filed my regular personal. So it's all messed up now. And then the government could actually move into the next worst category, which is double taxation, which is the C Corp. That's when you get taxed on the money coming in and you get taxed when you take it out again. And we can get into that another day as well. But if you haven't heard today that it sounds simple, it goes simple, but then it gets into these gray areas where you need to get a tax person involved.
Okay. Hey, Dave, this is Dean. Can I ask a quick question?
Oh, absolutely. This is
would, as a general rule, would it make any sense at all that if you are a company and you start to have employees, that you should consider the S Corp?
Yeah, if for yourself, if you got to the point where you could pay other people, then you should probably throw yourself in there and do an S Corp. I mean, you can certainly pay other people as a regular business owner and just, you know, treat it as an expense and 1099 and W. You could W-2 them, so the employer would W-2 all the people and then have it. So one of the problems really for a lot of business owners is trying to determine whether they should 1099 somebody or treat them as an employee and give them a W-2. And there's a disincentive. The government creates a disincentive to create employees, because if you're moving out, and I work with Shar, and I'm like, Shar, I'm going to give you $500. In my head, it's $500. In Shar's head, it's $500. But if she's an employee and she gets that check for $325, she's a little disgruntled. And when I have to pay $575, I'm disgruntled. And so we're both sitting there going, man, can't there be a better way for us to work this out? So she goes, oh, you know what? Just treat me as an independent contractor. Don't do any payroll. Just give me the $500 directly. I'm like, great, because I can pay $500 and expense $500, and you can take care of your own taxes, correct? And Char's like, yeah, you know, I'll figure it out. Just give me the $500. Well, that's kind of what's been happening lately, is a lot of people just kind of 1099 everybody. The problem is if Char is actually an employee and the IRS uses control, if she's actually wearing the shirt, coming to the office every day, sits at a desk, answering phones, they will determine whether you like it or not that she's an employee. You should have taken taxes out for her and treated her like payroll and done pay all the payroll tax, etc. And you, business owner, you're gonna have to pay what she owes. So, and now, how does that come back to bite the business owner? How do they find out? Two ways. Char doesn't ever pay her taxes on the $500, right? Said she told me she would, and she didn't do it, and they audit her and they find out that she should have been an employee in the first place. That's out. But the real reason, then the most of the time where it pops up with client, Char works for me for, 4 or 5 months, and then I'm like, Char, business is slow, I'm gonna have to let you go. Okay. Char goes to file unemployment, because she's like, well, I've been working with Dave and he paid me $500 a week, so I'm gonna go file for unemployment. Well, the problem is the Department of Labor goes, I don't really see this company down here, and I don't see you on the payroll for this company. Why? Because they're getting the information when you file your payroll taxes. Right. I don't see anything. Oh yeah, I work for him. I wore a shirt. I sat at the desk and everything. And so they do an audit. They come in and go, hey, this person said they work for you as an employee. And now you got to explain your whole system to somebody. Go, oh, well, they're an independent contractor. We have this contract here, see? And they go, nah, we don't care about that contract. That person should have been an employee. They should have been taking out taxes. And some of that is the unemployment. And then they'll tell the employer, you owe for the unemployment, you owe for all this other stuff. And let me see who else is working for you as an independent contractor. It opens up all these things. So I know everyone wants to get around the employment issue by 1099ing people, but you really need to do a good examination with an accountant about who on your staff should really be employees, and you have to set up withholdings and who you can get away with 1099. If the person you're 1099ing doesn't have a website and LLC, that's what I always tell people. That person needs a website and LLC before you can 1099 them. If they don't have a website and LLC showing like they can generate money doing other things, then I would not 1099 them. You err on the side of bringing them in. Now you have a certain time frame. You can determine if somebody's going to be an employee or not. I think it's like 90 days. I'm sure employment lawyers out there are like, ooh, I know that. But you have some time where you can treat somebody as an independent contractor early, but ultimately you have to move them into being an employee at some point.
I work with a number of independent, people. They're what do you call it? Well, they do all kinds of videography. They do contract work. So what I hear you saying though is, when I'm dealing with those folks who claim that they are in fact a business and they're contractors, I should, in order to protect myself, get their business name, their business, their LLC number or whatever.
what you'll ask for, and you might have seen this from other companies, you ask for a W-9.
That's what it is. Yeah.
Yes, you
W-9.
ask for a
Okay.
W-9. A W-9 from your contractor gives you the name of their company and their EIN number. So what usually happens at the end of the year, my accountant will say, "Hey, I see you've been paying this Ashar. Like, where's their information?" I'm like, "What do you mean?" It's like, "Well, we need a 1099 them to tell the government we've given them money." And then you got to go back and find them. Like, "Oh, Ashar, can you fill out this
Yeah.
form?" So a lot of times I try to get clients in the habit of getting that form early,
That
so you
makes
don't have
sense.
to ask it for it later. So at the end of the year, you say, "Hey, I paid Shar, $5,000, and here's a 1099 to the government saying that I paid him because I want to be able to do the expenses." There's also rules about when you have to issue that 1099,
Yeah.
how much money somebody has to have made before they get a 1099.
Yeah.
Again, all stuff that I don't lose any sleep over because I hire somebody to do it.
Right. Very good. Thank you.
So, Dave, why don't you just go ahead and tell us a little bit about yourself at this point, and who is David Walker?
Yeah, I mean, so I'm a business attorney, and I work exclusively with business owners, and I help them, start their business, buy and sell business, raise capital. I freaking love being a business attorney. I love taking people in that place of anxiety and moving them over to a place of calm. A lot of people call me very panicked with different issues. Hey, this is happening, that's happening, and they're very nervous about their business. And I love calm them down, letting them realize that, hey, this is how business works. It's going to be okay. And that, you're going to make it. So for me, and besides being a business attorney, I enjoy, the thrill of balancing life, right? So I have 4 daughters. Talked about Skylar earlier, how she's just now starting Stanford, and being a father and having a wife who's also an entrepreneur. My wife is a sex therapist. She has her own practice, and that's going well. And it's great to have another entrepreneur in the house that has similar issues. And it's funny because she has clients and I have clients. All her clients are named Betty, some random name. Trust me, you don't want to know their names. But just sharing the idea on how things work. How do you retain clients, the follow-up? There's all things that relates to clients that has nothing directly to do with law or even sex therapy. It's just about the business of managing things. And I'm originally from Detroit, and I don't want to talk about the Detroit Lions. I'm very upset still. I'm very upset that they dropped the touchdown pass to win the game. But you know what? It's going to be okay. Hopefully this week we get back on the winning side, beat up on the Packers. Same thing with the Falcons. That just ran into a very tough Russell Wilson. And, maybe that the team just had their card that day. But hopefully they both get back on track this week. I also own the bottled water business. Talked about positivity, sponsorship for positivity. Think positive, drink positivity. And I'm also building a closed loop manufacturing plant that'll produce water and also collect the waters to turn the preform pellets back into a bottle again. So that's a very exciting project. And lastly, I'm an NFL agent. And I love working with those players, not only on, trying to get them into the NFL, but also kind of working on their business structure. I've done this for a while, 22 years, worked with big businesses, small businesses of all kinds, all industries, different sizes. Every business starts with a thought from a business owner somewhere, one person, and it spreads and it goes. And sometimes it goes faster than the person expects. And that's okay, because I'm here to help them explain why it went that fast, what they can do to minimize the risk and how to move forward. And I kind of been down the road before, so I can see the light a little bit further. So what we do here at the Business Owner Movement is each week we try to bring a new topic and bring in different people to ask questions and to kind of have an open discussion, an open forum to discuss what's on their mind. Sometimes it's not directly related to the topic of the day. Sometimes it is. So we ask that anybody who has any questions or who have a topic that they want to quickly discuss, they can do that at this time. So Shard, do we have any sort of questions? I know, Dean, you mentioned your question about, when should you elect to be an S Corp? And to follow up on that too, Dean, is that it used to be that you had to make your S Corp election within a certain amount of time to form your company. I think the IRS has become a little bit more flexible on that. So if you didn't set up your company to be taxed as an S Corp and you really want to move in that direction, talk to your accountant, because I think you can still elect to do that during a year now. I'm not sure, but I think I remember an accountant telling me that somebody can still do it. That stuff changes every time, every day, every hour, all the time.
Yeah,
I mean,
yeah.
I don't want to stay on top of that stuff.
Hey, David, we have somebody that is with us today, Miss Kashina, I believe is the correct way to pronounce your name. And we've unmuted you. So if you'd like to ask Atlanta business attorney David Walker a question, please go ahead.
Okay. Good morning, everyone. How are you all doing today?
Good morning. Good morning.
I thank you for this information. I'm looking at your sheet here. My name is Kashina, and I'm a part of NOLB CE, No One Left Behind Community Empowerment. We are a business. Mr. David have been working with us, and some exciting news that we have issued out 3 grants, our first grants this week. So everything is rolling very well, and we owe everything to Mr. Walker. And so I just want to say thank you so much for that. But I did have a question in regards, because I noticed that you mentioned 1099s.
Yes.
You know, we're fresh and up and running. Is it anything that is over $600? You know, with the type of business that we have, should we be trying to prepare to issue those out at the end of the year?
Yeah, definitely talk to your accountant about the threshold. I'm not sure the threshold. I think it's something like that, but do that. But that more importantly is to grab the information of that person's social security number or EIN when you first engage with them. A lot of times these people don't want, a lot of times they'll duck and dodge you in January. You're like, hey, I need to get my 1099 out. What's your social security number or your EIN? And like, oh, let me call you back.
Correct.
They don't want you to tell the IRS that they got the money. So like, that's why you see a lot of times when businesses get these contracts, they'll send you out a W-9 asking for that information ahead of time because they know you don't want to tell the IRS. The problem is if you don't do this and tell the IRS, then you have issues with whether you can deduct it as a business. And so they'll say that's not a legitimate expense because you didn't 1099 it properly. Now you're paying taxes on money that you didn't intend to as a profit. So it's important to grab the information, and then your accountant usually is able to populate some system and get that stuff all shipped out to the right people and to the IRS within a certain time frame. I believe they have to be done by like January 31st or something. Maybe it's February 15th, but you have to get them out pretty quickly, just like you have to get the W-2s out as well. If you have more than one business owner and you're taxed as what's called a partnership, that means you take the profit and you split it up between 2 partners. Then the document you give the partner is called the K-1.
K-1. Right.
Hey, we made $50,000. We had expenses of $25,000, meaning that now we have a profit of $25,000. I'm going to be responsible for $12,500. You're going to be responsible for $12,500. And then you give them a K-1 to the government and to your partner saying, hey, I gave my partner $12,500 for his share of her share of the business. And then they have to claim it on their taxes. So deadlines for all 3 of those things: W-2s for your employees, 1099 for independent contractors, K-1s for partners, they're all due within like the first month and a half of the year. That's why all these tax people are going crazy, because they got to get these 1099s, W-2s, K-1s out. Then they got to file the March. They got to file a tax return for S Corps. And then April, obviously, you got to do taxes. So that's really why it's called tax season for them, because it's a hectic time of the year.
Okay, I thank you so much. And last but not least, the people that are receiving the grant, those are the ones that will actually be doing the taxes, or is it the one that's actually giving? Just wanted to clarify that.
Or receiving, because if they're receiving, they treat it as revenue, and they'll have to book it as revenue.
Okay, thank you.
Yep.
And so, David, just want to kind of talk to Dean a little bit, because with his business that he's helping people to ensure for financial success and talking about taxes. Just wondering, Dean, if you had any insights that you wanted to share with everyone today.
You know, it's amazing what small businesses learn as they go along. Hopefully, Uncle Sam hasn't figured out my errors of the path yet.
Well,
Remember,
I think that you have like a trailing 5-year statute of limitations.
yeah,
So
yeah,
that's
you
the other
told me
thing.
that.
That's the other thing too about the government is that your error in the things that you do is not caught in real time. So
Yeah,
you make $100,000 in profit and you don't tell the government, they're not going to come in on your door on January 1st and go, you made $100,000, Dean, last year. You plan on not reporting it this year. No, you don't report it. Something happens 2 or 3 years later. They're like, hey, Dean, remember back in 2020?
yeah,
Looking at the
yeah,
door like, what? I don't
yeah,
have any receipts or I don't really remember that. They don't,
yeah,
that's not an excuse.
yeah,
So
yeah,
that's the, you have to be careful. Go ahead.
yeah.